All right. So last week or the very first week, we basically went over the basics of what is Forex and things like that, and I helped you all set up the charts. Okay. This week we got a little bit more detailed as far as getting into Elliott Wave and Fibonacci and how they coincide with each other. All right. Um, Elliott Wave, again, as we all know, describes the psychology, the math psychology behind the market. Okay. Um, it gives you a way to figure out what's going on in the market when you're trying to analyze them and things like that as well. Because we know different characteristics within the waves. All right. And what is a wave again? A wave is an impulse, up or down, and then a retracement or a pullback is against the trend. Then we've got another push up, another pullback, then another push up. And from this swing low, from this swing low to this swing high consists of 5 waves of Elliott. All right. So from this particular low, let me mark these out for you. No, let's do darker. So from this particular low to this high is wave 1. From this high to this low on that retracement is wave 2. From this low to this high, that's wave 3. From these highs to these lows, wave 4. From this low to this high, that's wave 5. Okay? That's only part of a complete cycle of Elliott Wave. Because just like each individual wave right here has a retracement, this first whole wave is going to have its own retracement. Okay? And it's going to go from this high to this low. Well, let me change this color to blue. All right. So this is the retracement of this move right here, from this low to this high. Because even though there's each individual retracements of these waves right here, as a whole, they haven't had a retracement yet. So this low and this low hasn't been tested yet. That comes with this retracement right here. And on these retracements, it doesn't really, you don't have to label them on your charts or anything like that once you get familiar, but for the training purpose, I'm going to label them for you. So from this high to this low, you've got wave A. From this low to this high is wave B. And then from this high to this low is wave C. Okay. So now that we have that complete 8 waves, you've got the 5 up and the 3 down, 1 through 5, the ABC, that's a complete Elliott wave cycle. That's one wave. Okay. So after this C completes, we're going to see another wave like this of 5 to some degree kick off in an up direction on an uptrend, or if you're going down, you're going to see another wave of this degree going down. Okay. We identify Elliott Wave starting with a guideline of alternation. It's a rule of thumb basically. Okay. It stays true more times than not, but like I said, it's a rule of thumb. What the guideline of alternation says is if wave 2 has the steep retracement then wave 4 is going to be sideways, like this, like a zigzag, some kind of consolidation or compression in the market. On the flip side of that, if wave 2 moves sideways, then wave 4 should be the deeper one. And that's the guideline of alternation. So when we're first looking for Elliott Wave after we're analyzing the charts, that's the first thing that's coming to my mind is look for the pullbacks within the main trend. Because if you're able to identify the pullbacks on waves 2 and 4 or even on a wave 2, then you're going to be able to trade in line with the main trend. And that's what we want to do. So if you see the market retracing against a larger wave, you're going to wait until the market shows a bullish pattern, a bullish reversal, or find some kind of support where it's going to bounce up in the opposite direction like it is here, because it's going to test this high and more than likely it's going to continue up. And I'll show you all this on the charts, okay, as well. The next thing we look for on Elliott Wave is just the different characteristics within the impulse moves themselves. All right. So I told you guys that each of these waves, wave 1, 3, and 5, have different characteristics. Okay. Wave 1 tends to be barely identifiable. It tends to have still some bearish movement. More times than not, it looks like a drift up. Okay, and you'll see some strong bullish moves up. And as we get into market structure next week, you'll understand why it drifts up and why certain things happen at certain prices and so forth. But wave 1 tends to drift up before the retracement 2 happens. Okay, wave 3 tends to be the strongest and the steepest and the longest as far as the difference in price from low to high. Okay, wave 5 tends to be an extended wave, okay, in equal length to either wave 3 or 1. More times than not, it's wave 1, okay? And those are just different quick characteristics of each of wave 1, 3, and 5 that we can look for on the charts. And again, I'll show you on the charts as well. This week, we also got into Fibonacci, all right? And Fibonacci and Elliott Wave tends to have a nice relationship because what Fibonacci does is measures the retracements within an impulse move. So Fibonacci measures this retracement. How deep did this retracement come from this strong impulse move up? Okay. So what happens is we've got a few different fib ratios. We've got the 78.6, the 618, which is the golden ratio, and the 88.6, which is 3 different ratios we look to enter off of, okay, with market structure. Let's move this out the way. So what that really looks like is, let me see if I can draw something for you real quick. So for instance, on this retracement right here, if we wanted to catch this next move up, that next wave up, which is what we want to do, we wait for the market to pull back against this trend, find some kind of support. Then we would fib from this low. Come on. From that low to this high. And when we do that, we get a few different lines that populate, going over like this. Sorry about my squiggles. Okay, and more times than not, our entry is in between the 618 and the 886. Okay. And that's really all it is on a simple view or a simple term. as I'm drawing it up on the charts. It seems kind of simple to me. I don't know if it seems simple to you all, but that's really what it is. Once I teach you more of the candle patterns at these areas next week, you'll be able to comfortably, and I mean that comfortably, take some nice trades and things like that, because you're building a list of confluence, which is coming in next week, and you're going to be trading in line with this main trend. So you're going to catch some heavy moves. Okay. Let's see. Do you have any questions so far? Anybody got any questions yet? Let's see. All right, cool. We'll keep going. So let me show you all this real quick. So just as each of these individual retracements, right, on these waves have the same ratio, once this wave up, which could be like a wave 2, a wave 1, a wave 3, or a wave 5, on this retracement itself, guess what? We can also fib from this low to this high. All right, and then this same ratios are going to fall at each of these structure points in some way. And then you're going to look for the candle reversal pattern within that area for it to pop back up. So this is the whole cycles within the cycles. So a cycle within a cycle. That's what it looks like. It looks like a bunch of gibberish right now, but you'll get it eventually. So let's just take a look at the charts real quick, and I'll help you all identify this. All right, so check this out, guys. This is the chart USD CHF, what I said I wanted to go long on last class. That was on, what was that, Tuesday? Yes, I believe it was Tuesday. We had marked it up already, and I showed you guys this fib level. So what I'm going to do now is show you all Elliott Wave, just like I did as I drew it up. Okay. Like I said, this stuff isn't going to be real clear to you guys at first, but the more and more you see me mark it up, or the more and more you all study it, you'll be able to see it. Okay. So from this low to this high, well, first let me change the color. No, I don't like that. All right. Hold on, that's my pig. Hold on. What do you want, girl? What you doing, dude? Sorry about that. All right, so let me delete this real quick. All right, so what I'm looking for when I'm looking for the Elliott wave, I'm looking from this low to this high. All right, and I'm going to see if I can see the retracements. Like I said, it's not clear to you guys. Hold on. Thank you. All right. Sorry about that again. All right. So when I'm looking for Elliott Wave, first off, I'm looking for the move up or the trend. I'm trying to identify the trend. Here's the trend that I'm looking for right here, from this low to this high. Now, within that trend, there's areas of retracement within this move, and this move. They're very, to you, they were very minute, but to me, I see them clear as day. And again, this comes with time. So I'm going to try to highlight them for you. All right. So what I want to show you is from this high, from this low to this high. This is a retracement within itself, okay? This pin bar and then this single candle right here, that's a retracement, all right? From this low to this high, see this sideways movement? That's the wave forward. Steep wave two, well, not really too steep, but steep wave two, sideways wave four. Then you've got another move up, right? From this low to this high before another A, B, C of this wave itself. Okay, now let me mark this up. Let's see. One. Oh, change that color. Let's go with yellow. All right, now let's do the A, B, C. This high, this low, this high, down there. All right, so that's the complete cycle, guys, on the charts that we're looking at. Again, your eyes probably can't really identify it as easily as I can, but as you all continue to look at the charts, you all continue to attempt to apply it, it'll get easier and easier, okay? Don't worry about not having it down just yet, okay? I'm trying to think. Let's see. So next week, we're going to spend time learning about market structure and key levels. And what I mean by key levels is if I go to the monthly chart, you see I've got some lines over here that say monthly, weekly, monthly, weekly, monthly, weekly, right? Those are all key levels. And I remember in the first week, we went over support and resistance a little bit, right? These key levels take that whole concept to another level. And like I said, we'll get into that next week because I'll need to explain to you guys some of the candle patterns that form at these levels and what we're actually looking for to happen at these levels, depending on which trend we're looking at. And once I teach you this, though, I'm going to teach you both versions of it. I'm going to teach you the swing trade version of it, which is the way I prefer, and then I'll teach you like the intraday trading version of it. Okay. But let me finish this one real quick. And I'll show you, and this also will show you how these key levels play a major part in building confluence. All right. So when we set up the Fibonacci tool, we said we enter in between the 618 and the 886, right? And then let me take that off. And then our stop losses go below this one right here. Okay. So check this out. My ideal entry is this green line. This is where I set my pending orders typically. Okay. Notice what happens on this green line. And this is, by mind you, is on the daily chart, right? So if my pending order is already set right here, and again, we get into the price behind it as well, and then the timing behind it as well in further lessons. But my pending orders over here, my stop loss is down here. I've got little to no drawdown on this trade, and it pops up. If we go walk this down to the 4-hour chart, this is where you begin to get your wick entries or your quote unquote perfect entries, and things like that. And that's because the approach that I'm teaching guys to do, and that's the multi-chart analysis. Because if you know what's playing out on the larger time charts, guess what's going to show on the shorter ones? It's going to begin to show on the smaller time charts before it shows on the larger. And that's why we do a multi-chart analysis. So if we expect, let's say, if we're intraday trading, we're going to be on the 4-hour. And if we're expecting the 4-hour, to pop up, I'm not going to enter off of the 4-hour. I'm going to go to, I'm going to walk it down to the 1-hour to see if the 1-hour is going to start to agree with whatever the 4-hour is predicting. From there, I'm going to go to the 15-minute chart and I'm going to enter. And that's what we're eventually going to be doing. So I'm gonna go to a fresh chart, and I'm gonna show you all the full thing. Basically, I'm going to show you all completely what you're going to be doing. Let me see something that's not marked up. Nope, marked up. And let's see. Never traded it, never marked it up. Cool beans. All right, so damn, I did mark it up. Well, let's try something else. I mark up a lot of stuff, dude. But look at how these key levels or these lines and prices reacting to these lines, guys. When I teach you this stuff, it's going to be, some pretty changing stuff. But shoot, let's see. Actually, let's do a cryptocurrency. No, there's not enough data. Not enough data for me. All right, cool. We'll try this one. All right. So this is a fresh chart to me, right, guys? So what I'm doing is I'm going to now mark up my strongest levels of support and resistance. And I get that from the monthly chart, okay, because I'm a swing trader. This is the swing trade version of it. So first off, what I'm doing is identifying the most recent trend, all right? And by doing that, I see here's an uptrend, retracement, never crossed that low, and then from this low to this high. So I'm going from this low to this high is my uptrend, all right? Now, the way this works is these key levels are based off several things, okay? They're based off of price, which is over here, and they're based off a theory called quarters theory, which is something I'm going to be teaching you as well. So basically what it is it says price doesn't really move randomly, but it has predetermined or predestined movements, and it moves on 1,000 pip blocks or 1,000 pip movements at a time, depending on the currency you're looking at. Some of them move like 2,000. But basically, what I do is, or what we're going to be doing, is identifying these key levels and put them at price. So we know that it's, we're expecting an uptrend. We're looking from this low to this high, and then this low to this high. So what I'm going to do is I'm going to mark those because again, we're on the monthly chart. If price is rejecting on the monthly chart, guess what happens when it comes to that same price level again? More than likely, it's going to do the same thing. History repeats itself, basically, okay? So I'm looking left at previous swing points, or for this training, at previous fractals that were tested right here. So from this low, I'm going to put my chart, or my line, my horizontal line. And this is a monthly key level. Now the thing with this key level is I want to try to have it at a nice clean number. Okay. So notice though, right now I just clicked it on there and it's set 75 cents 008. So I'm going to put it at 75 even. All right. Now with this theory, quarters theory, creating these key levels, you got to do 1,000 pip ranges or 2,000 pip ranges, depending on the currency. With this currency, I'm going to do 1,000 pip ranges. To keep it simple, from 75 cents to 85 cents. Okay, 10 cents. That's the difference I'm going to be doing. That's 1,000 pips. Let's see. So what I can do is just click on the chart and put it at 85 even. And then when I do that, I'm looking at price. You see price over here, how it bounced off of it, another bounce off of it, another bounce before a final breakthrough. Here it activates it as a resistance, bounce, resistance, breakthrough, test, bounce up, another test, bounce up, breakthrough, resistance. You see how price works, or I mean, price is reacting around this level. So that lets me know that's a good level to have basically on my chart. Now I'm going to create 3 more zones of 1,000, if I'm able to, depending on what I'm looking at. So from 85 to 95. 95 even, I like it. And again, I'm looking at price. I'm looking at these candles to see how they reacted to that price area. And sure enough, there's either a nice breakthrough or a nice bounce at that level. Bounce, 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 right? So here's my first 2 blocks. I'm going to do a third one. So from 95 to 105. All right, again, rejection, 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 nice rejection, rejection, bounce, rejection. Again, I'm looking at previous candles to see how they reacted around this price. And it lets me know that's a good, level that I want to watch. All right. So now that we've got our monthly key levels on there, what we do now is we cut that in half. Okay, because price doesn't just move from one point to another in a straight line. There's usually retracements within it. Okay, and I'll show you on this on a lower time chart. But let's see. So all I would do now is just cut them in half. So from 95 to what, $1 even. And again, I look for price to see how it reacted. All right. Another key level. Let's get you off of there. Let's see. So you cut each block in half. And you're just going to validate it with previous price structure. All right. Now, once we have all those marked, or once you have these zones marked, you typically don't have to move those lines or mark them up on this chart again until price breaks either up above this or down below this. So, because these zones are going to stay true for as long as it goes. All right. You don't have to move them, don't have to do anything with them. So from that chart, I go all the way down to the to the daily chart. And when I do this, I zoom out a little bit because I want to see, previous cycles and how they finished. Let me zoom out some more. I gotta show you this. All right, so we'll go right here. So we're looking from this low to this high, right? Because on this retracement, this high didn't get it hasn't been crossed, and then this low hasn't been crossed. So this is the range that price is trading within. Okay, and that's how you recognize a pullback within any cycle. But on a major view, from this low to this high, here's a pullback. Even though this goes up here and tests this high, it never got crossed. So now it's going down to test this low. It's never got this low hasn't been crossed yet, right? So what actually happened is here's your low, here's a higher low, here's a higher low. So if we're looking for a W formation, it's already started to pop up, right? This high up here is what's getting tested, and this is on the daily. So what determines if it's going to make it up there though is this first price structure, because we've got a nice weekly key level right there, and we've got previous price that rejected. Okay, so what we must do though, let's see, let me zoom in a little bit. So what I do is I use this MACD indicator, all right? And the way I use this, or the way you use this, is the colors differentiate between the strength or the momentum of the market. The bars tell you the strength or the trend of the market. So as I see each bar gets higher and higher than before, I understand that, this is still going up, right? Cool. So my first thought or first bias is to buy. Okay, strong uptrend, retracement, strong uptrend, maybe a small retracement, and then a buy. Okay, and now again, I'm going to teach you some things about price structure, market structure in the weeks coming up, because this right here is very important. This high right here, because as you see, price came up, even though there's pin bars right here, price is still closing above these highs right here, which is a big important thing. It's below this weekly, but it's still closing above this. So what we could see is a nice retracement pullback that will come and trade within this range before it pops back up with a nice strong move, because that's what it's going to take to break through this weekly level. It's some kind of strong move. All right. So even though I'm long, right, I'm not going to enter in long just yet. All right. So I'm going to go down to the 4-hour chart. Now, here's the view. So here's that high from the daily chart that I was talking about. All right, as you can see, price already came down, tested that high, went up a little bit, but again, we're below this weekly level. So let me see, there's something real quick. No, we're still below. Okay. So these are all telltale signs that price is going to enter a retracement, but not necessarily, be a downtrend, just a retracement. What's going to happen is it's going to retrace again, test this top in a nice strong fashion, might even test this low and pop back up. If price gets below this right here, then you'll see it go short even more. But as it continues to close, we'll see some nice strong movement up. Not only that, the daily chart itself still showed some movement up. So depending on these next couple days, again, we'll have to reevaluate. But for now, we'll still be long. And this is what we want to see right here. So now I went from the 4-hour to the 1 hour. And basically what I'm looking for is the pullback against the trend. Because smart money always buys against the trend. Because that gives you the best position. I miss you too, baby. It gives you the best position in earning your money, basically. For instance, let me use this trend. Smart money. This, I can see. Smart money isn't buying on these green candles. No, on an uptrend. They're buying in the red candles because they know price is going to go up. If people are selling or giving you a discount on something that you know in the future is going to go up, you're going to take that discount in the store, if that makes sense, right? So smart money is buying in these bearish candles. On this double bottom or triple bottom, this move down got everybody to sell. Here's a retracement. And on this failure to break this low, this is where smart money's buying, because they're in position now to catch all of this. And that's trading, that's called institutional trading, and that's trading in line with like the major players of the market. And this is something else that I'm going to teach you all in the future, once I teach you all market structure. But so since we're looking to go long, what we're going to do is let the market retrace, right? Let the market pull back. So what I would do is fill from this low all the way to that high and let the market retrace. And this is that green zone, right, that I drew on what, the 4-hour chart and the daily chart. Look where your entries are at. And this is where you want to enter with previous market structure, because what's going to happen is it's going to find support. It's got to find a floor or validate a floor that it broke through. It's already done it a few times, right? But now it's got to do it on a larger degree to gain the momentum to pop through this ceiling right here. Y'all have any questions so far? All right, let's keep it moving. All right, so now that I've got that zone marked up on the 1 hour, right? What I do is I go to the 15-minute chart, and I just start to see different things in the market, basically get a different view for my entry. Because honestly, with this higher low and with this higher low right here, and this higher low right here, it's got a lot of support to really break through. But I like this low really because that's the strongest one. These candles right here made the biggest move or the biggest impact, I believe. So this high and this over here, it's got to get in that. So I'd like it to retrace deep, test this low right here, or test these lows for sure, which will be, let me move this over. In line, right, with this zone, which is from a higher time frame. So on this ABC correction, I mean, you know, expect something like that. I mean, it could take a while to play out, but you know, That's what we're expecting, because that would create, here's a shoulder, here's a head, and then here's a shoulder, but it's going to retrace back to the neckline and not break. It'll pop back up. And that's really the whole thing that I do, or that we're going to be doing. So Elliott Wave plays a little part of it, not a major part, but it plays a little part of it because it helps you identify, some waves or the trend of the market and things like that. So that way you can identify the correct impulse or the correct trend to fib and things like that. The key levels and training on how to properly use the MACD, training on the triple screen method, and then market structure and things like that are coming starting next week. And then we'll do one more week of the class, and then we'll spend the majority of the last week basically doing what I just did, marking up charts, making sure you're able to identify some things and just, getting everybody up to speed with stuff. Let's see. Y'all got any questions? Hey. No questions, guys? What do you guys think so far? Anybody need help with anything? Oh, hold on. Well, that's all I had tonight, guys. Like I said, I just wanted to review and give you guys just basically a general overview of what it is you're actually going to be doing as far as a whole. I have much more tonight, but I'll be ready for you guys on Monday with some good stuff. We'll start getting into market structure. So basically, I'll show you the swing points and what we're actually looking for, and some candle patterns that you all should be focused on. Other than that, guys, you all can enjoy your Saturday. We'll keep this one short. All right. I'll ask one more time. Any questions? Kenyatta, you got a question? Oh, you're welcome, Michelle. We appreciate y'all's time tonight. All right. Y'all have a good night.